Hey everyone, my name is Sam and I'm going to be teaching you guys how to go from beginner to pro day trader in under 12 minutes. So check this out. Before we jump into it, I actually have taught over 2,500 people just like yourself learn how to trade stocks, whether you have some knowledge, no knowledge, or anything in between. I've taught all different types of levels of how to make money with stocks. So yeah, just make sure to watch this entire video and don't miss any of the details. So what is day trading? Day trading is essentially buying and selling a position in the stock market within the same day. So let's say you buy a trade a couple minutes after the market opens and then you sell it a couple minutes before the market closes. That is considered a day trade or anything in between, such as if you hold a trade for maybe a minute all the way up to 10 minutes or maybe even an hour in that trading day, you're essentially holding a day trade. So first, you're going to need a broker. So this is the broker that I'll be going over in this video is called Charles Schwab, and it's the TOS system known as Thinkorswim. This is the best platform that I have found, and many of my students actually use this as well. So once you actually log in and create an account and all that on their website, you'll be able to access their Thinkorswim platform. And then from there, you have a bunch of tabs such as the monitor, trade, analyze, scan, market watch, charts, tools, education, and help. Bunch of stuff you can use to learn and utilize within the Thinkorswim platform, which is great. And it's a free platform as well, and it's free to sign up for Schwab as well, which is cool. So once we go to on the charts tab, you can see that I have the stock Tesla, TSLA, and I have these indicators, the 9 and the 21 EMA. I'm not going to be going over that in this video, but this is just an example of a chart. And so if you zoom in, these are known as candlesticks. So candlesticks are known as the price action. So when a candle opens at, let's say, 209.84, which is the current price for this right here, and then it closes below that, about $1 below that, that is known as a bearish candle, and that creates a red candle. So basically the open is higher than the close, is representing a bearish candle to the downside, and then the opposite for green candles. So green candles, let's just say for this example, is 206.60, and so then you close above that, which is that flat line, at 208. So basically $1 and 30 cents higher for the close. And these top wicks mean that this is the high of the candle. So in this time frame, the 5 minutes, which is this is the 5 minute time frame. Each of these candles represent 5 minutes. So each of the top right here, this is the height of the and within these 5 minutes of this time of this candle, the height of the price that it reached a high was 211.86, and the low, which is basically the open. So let's go to a different example. So basically the low of this right here was 206.22, and then the high was 208.10. But the candle did open right here at the 207.86 level and did close a little bit before that for it to create that red candle. And basically when the candles are thin on the bottom, that means that there's a lot of buyers pulling it up, and then there's also sellers pushing it down right here. So basically that's why the candle ended up creating this shape that's thin compared to other candles where it basically opened right here, a lot of selling pressure, pushed it all the way down, and that's how it went. The options world, this is called the calls and puts. So calls meaning that you think the stock's going to go up in price, and then puts meaning that you think the stock's going to go down in price. That's the most basic understanding of it to explain it. And there's other things that go into it, such as option Greeks, such as you can see right here, such as delta, gamma, theta, and vega, which is a different type of video that I'll be going over in the future. But essentially, when you're doing calls, you think the stock's going to go up. So the current price is $220.40. So if I think the stock's going to go up, I'm going to buy the strike, rather the first in the money, the first out of the money, thinking that the stock's going to go up. So the way I'm going to do that is I'm going to hit the ask, and as you can see down here, you can see that it'll create a little green bar down here, which you can't see right now, but it just creates a green bar, and then that's how you buy, and this is how you sell. So then the difference between these two is known as the spread. So 435 and then 430, that's known as a 5-cent spread. Spread meaning the difference between the two. So basically, you can get a fill at one of the, so if you're buying, you get the at the market orders. Market meaning that you want to get into a trade right away. You can also do limit orders, which means that you're basically picking the price that you want to get into this trade with. But essentially, the spread is just now 10 cents, and now it's 5 cents. It changes all the time, depends on the stocks. Such as if there's a lower volume stock, the spread is usually higher. But since this stock has about 61 million volume, Tesla has a very tight spread for the very close to end the money. Compared to also if you want to go out of the money, But essentially, for what this date means, September 6th, 2024, that means that is the closest, that's the expiration of this trade. Today is September 4th. So basically, in 2 days, any of these trades that you hold till the market close of September 6th will be worthless. Whether you put $1,000 in or not, if you're buying a naked or if you're buying a call or a put, it'll be worth nothing. So I always try to sell before the market close for sure. I personally never trade the same day expirations when I'm day trading on Tesla or any other stocks because it's too risky because of time decay and all that. Time decay meaning it's one of the option Greeks, which I was going over earlier, which is theta. So the closer that it gets to that expiration, the cheaper and more worthless the contract gets. It's a bit complicated. That's a different video in itself. But essentially, if I also want, so going back to like getting into the trade, I'll be hitting the 445 to buy in, and then picking the amount of contracts and picking the market order type. And then if I want to sell, I can hit this bid side and I can type the amount of contracts, make sure that I'm trying to get out of my position entirely. I would match the same amount of contracts that I bought in, such as if I bought 10 contracts at the ask, I'd also do 10 contracts at the bid and hit sell. So that's pretty much it for the strikes and the calls and the puts and the like data and all that. But essentially, the closer the expiration, the higher the risk, more profitable it can be because it's getting closer and closer to expiration. So little moves tend to yield higher profits compared to you doing like a few months out. And then also, I'm going to be going over the put side just to be a very brief. So when it comes to the put side, puts meaning that you think the stock's going to drop in value. That's essentially the idea of the puts and the option contract world is at least. So essentially, I'll be hitting the ask to click the buy puts, and I'll be hitting the bid to sell the puts. And these are the same type of strikes. I'd basically buy, what I personally like to do for day trading is buy the first in the money or out of the money, just whichever one is like the most reasonable. So currently the stock is around the 220 mark, so I'll be looking to buy around this one out of the money. If I'm thinking the stock's going to drop to 220 at least, I'll be looking for that. And yeah, that's basically the summary for calls and puts and strikes. So when it comes to the actual charts, you can see that there's indicators on the charts, and you can do that by going to the studies tab and hitting studies, and you can see that there's a bunch of indicators. I currently have the stochastic slow with the 9 EMA and the 21 EMA, as well as the volume. And the green line is essentially the 21 EMA, which is basically the average of the last 21 candles. And the blue one is basically the average of the last 9 candles, such as this point right here at 206.02 is the average of all these candles in the past. And then for the 21 right here above it, it's the average of the last 21 candles, for example. And then volume is just basically what is the volume of the contracts or the shares, that are happening in that moment on that time frame. And that's basically it for the indicators. So a simple, very brief, basic strategy that works somewhat good at the time is just literally the cross of the 9 and the 21 EMA. As you can see, once the 9 EMA crossed below the 21 EMA, the stock continued to drop in price. And as you can see, when the 9 was above the 21 EMA, it actually was staying bullish until it happened and it crossed and it went to the downside. This is a very basic strategy. I don't use this one all the time. It's just something that you can use as a basics to learn from and go about it to a new strategy. So a very important part of trading is having stop losses and managing risk and having a game plan when you're going into a trade. Such as for this example right here, let's just say I buy into puts because I see this rejection on this candle and I see it come back up, and I'm buying puts right here at this that close and that open. On this candle, I'm buying the puts right here, and I get a little bit of a stop loss right here, or about a 57-cent move to the upside, and I would have my stop loss at the next psychological number, which was 215 right here. So basically I'm entering right here at the 214.30, and I'm looking for the stock to drop as much as it can, preferably even to the 21 EMA. And so as you can see, it went from 214.30 to now about 212. So that's about a $2.30 drop for about risking about like 65 cents to the upside. And it basically rejected it on the dot, if not a little bit 5 cents below the 215 level. So it held that, rejected it, and that would have been a solid trade right there, especially since there was a lot of supporting things, such as there was a big push up, and then there was rejection right here, and then another rejection, and it pulled back. And also the volume was dying down. As you can see, the volume was slowing down, so that usually means that there is more bears in territory, and that is a weak push up. Another thing that is very important that I do when it comes to trading stocks is I back test my strategies very much. Like I go at least a few years in the past to look at every single day, make sure the setups worked on these certain days, and if they didn't work on certain days, I would see if there was a certain like Federal Reserve meeting or someone speaking like a speech, like Powell or somebody like that, and go about it and see if that was like a major indicator for why that did not work that day or anything like that. And then just keep on back testing, see what worked, see what didn't, add new indicators, remove indicators, just remove, like do price action. There's a lot of different things you can do when it comes to back testing. You just got to do your knowledge and see how far backing you do and go about it that way. So when you are ready to get started trading stocks, Schwab does have a great platform with TD Ameritrade for a paper trading account, so you don't even need to trade with real money to begin with. You can actually sign up and just sign into the paper trading account, and you can start to trade with fake money while you start to gain confidence and understand how to place and sell trades. I've done that in the past. I've helped my students get started with that. Like, it's very useful to get started with learning and understanding how fast the stock market can go, if you're day trading especially. And it's just a great tool to have because it can actually give you somewhat of accurate predictions. Obviously, the profits are not going to be very exact, especially if you don't have the real-time data set up exactly in the correct way in your account. So just make sure to look out for that as well. So yeah, that is essentially how you get from beginner day trader to pro day trader in a very quick amount of video. So make sure to like this video, subscribe, and comment down below what you enjoyed. And if you want to type stocks and get to the next step with all this, you can also click the link in my bio and go from there as well. And yeah, I hope to see you guys in the next video. I'll see you there.